rupee has slipped to around 90 rupees per US dollar, emerging as the weakest Asian currency in 2025. This depreciation is striking because it's occurred despite strong GDP growth of about 8%, pointing to deeper stress in India's external sector rather than domestic growth conditions. But let's begin by understanding how the rupees moved over the years. During independence, the rupee was fixed at 4.76 rupees per dollar under a controlled exchange system. This rate held right up until 1966, when wars, drought and falling foreign reserves forced India to devalue the currency. The oil shocks of the 1970s and rising external debt pushed it lower, and by 1990 the rupee had fallen to around 17 rupees and 50 paise per dollar. The 1991 balance of payments crisis marked a turning point. India devalued the rupee and adopted economic liberalization, moving to a market-determined exchange rate by 1993. Now, while growth improved, the rupee continued to depreciate, touching about 43 rupees by the late 1990s. In the 2000s, strong IT exports and capital inflows offered temporary support, but dependence on oil imports kept the rupee volatile. The 2008 global financial crisis triggered sharp outflows, weakening the currency again. By 2014, the rupee crossed 60 rupees, and over the past decade, it slipped from around 62 rupees to nearly 90 rupees per dollar, reflecting sustained external imbalances. So why is this happening? Why does the rupee keep losing value? Well, the rupee's decline is rooted in structural weaknesses. India runs a chronic trade deficit because it relies heavily on imports such as crude oil, gold and electronics. This keeps demand for dollars high and widens the current account deficit, especially when oil prices rise. The pressure increases when capital inflows weaken. Now, foreign portfolio investors pull out money due to higher US returns, global risk aversion and uncertainty over India-US trade ties. Global shocks, geopolitical tensions, energy price spikes all boosted the dollar's safe haven appeal. At the same time, the RBI's focus on growth through rate cuts with limited forex intervention has left the rupee more exposed to market forces. Now, other than these factors, the government is also attributing the rupee's collapse, yes, to Trump tariffs. US tariff hikes imposed in 2025 on Indian exports have worsened the sentiment. The higher duties affecting a large share of exports to the US reduced competitiveness. It dampened investor confidence and added pressure on the rupee. Though they're not the sole cause of the decline, they're definitely a factor. A falling rupee makes imports costlier, fuels inflation and widens the trade deficit. It also raises debt servicing costs for companies and the government and increases the risk of further capital outflows. This makes the currency slide a real concern for the broader economy.